Um, Dan and Michael have touched a lot on some of the things I'm going to talk about, and I'm trying to pitch this at the right level. Dan and I had a lot of conversations about where to pitch this. So this is assuming that you are starting at the left-hand quadrant where Dan left off. You're just starting a business. You've got your first term sheet, and you're very excited. The thing not to do is go and sign that without reading it. So this should say the glass is actually half empty. And I'm sorry to rain on your parade, but there are 4 key areas that you should look into, which will sound a bit complex, but once you get to know the lingo, it's really not that bad. So first is about valuation. And this is about the size of the cake today, how much money goes in, either today or tomorrow, and how much of a share of that cake you have left. Now, one of the themes that Dan has mentioned and is playing out in the news these days around valuations of private companies and have they gone too far. What you want to do is you want to make sure you are reasonable about valuation so that in the future, when you're looking for new investors or you're asking your existing investors to pony up some more money, then your underlying performance will justify the valuation. Remember, valuation is very much of an art. It's not a science. It's what you want and what they're willing to give. So it's a negotiation. And what you don't want to do is be very greedy today, but forget about what comes down in 2 or 3 years when you might lose control of your company. The 2 other things to mention here is that the headline valuation today is only part of the discussion. If you're talking to a strategic like a Diageo or a Pernod, they will want to be able to buy your company at a set price in the future. And that's called a call option. The other is you may have an earnout where after you've sold your company, now again, we're thinking 5 years into the future, you're due some money because of performance that will be under someone else's watch. So these are all things you want to discuss in valuation. You look at it in the round. You don't look at just a number today. Governance is around who ends up riding home, to be very crude. A lot of your early investors will want rights over decisions that could be quite key to you. So what they call reserve matters on things such as who you can hire, how much you can spend on CapEx, what you can do, and this comes to non-compete, what you can do after you sell your company, and what sectors you're able to compete with your original investment. So these are all things you want to take into consideration. And again, valuation is only one piece of the puzzle. All of these other aspects of the term sheet are quite key if you want to have a life that is equitable with your investor, right? And change of control is one that is increasingly prevalent, especially when you're dealing with incubators or with other sort of professional investors like VCs. There will be events when it is possible that you are forced to sell your company. Maybe you get a lot of money, but there are situations where or the events will arise where an investor says, I've got a really good price for the entire company, and you have no option but to exit with the investor. So these are called change of control clauses, and it's something you want to make sure you keep an eye on. The next is capital structure. And this is all about not being taken to cleaners. So capital structure is a fancy way of saying how is the company financed. So you have debt from the bank, which you don't often get as a startup, and you have equity. And in between, there are layers of instruments called preferred equity or preferred debt, which effectively give early investors a first bite at the pie when you're exiting the business. It can be so hefty, this bite, that there's nothing left for you, right? So pref rights is effectively who gets dibs over the money in the case of a liquidation or a sale to a business. All things that are probably good for you if you're looking to exit a business eventually, but things that you have to think about today because they'll have impact in 3 to 5 years. Speaking of impact in 3 to 5 years, you don't want any fireworks from the fine print. Now, reps and warranties is a section of the term sheet that even makes my eyes glaze over. I usually leave it to the lawyers. But this is to an earlier point that initial investors will not do much diligence. They will take your word for the fact that you have audited financials, that there's no funny stuff in your financials, that you own the IP for the business, that you own the formula, you own the website. And you will effectively have to sign something just short of a personal guarantee that says everything that I provided you is truthful, gives the full picture, and nothing has been withheld. The flip side to that guarantee is that when things go wrong, your liability can effectively be up to 100% of either the consideration you receive or the money that the company receives. So with that, the trading wheels are off, and now go get your deal done.